Mr. Chairman, I look forward to the committee's questions.
Gentleman yields back. Acting Chair Hill, you're recognized for your 5 minutes of oral remarks.
Chairman Hill, Ranking Member Waters, and members of the committee, thank you for the opportunity to testify today. I appreciate the opportunity to report on the FDIC's recent work to improve our regulatory and supervisory approach across a number of areas while continuing to fulfill our core mission of ensuring deposits, promoting the safety and soundness of banks, and resolving failed institutions. Over the past 10 months, the FDIC has made significant progress in several areas, including reforming supervision so it is less process-driven and more focused on core financial risks, engaging in a thoughtful review of our regulations, guidance, and manuals, reevaluating numerous aspects of our resolution and receivership management functions, and promoting the prudent adoption of innovative technologies in the financial services sector. My written statement provides greater detail in each of these areas, but I would like to briefly touch on each of them. Regarding supervision, the FDIC is actively implementing changes to our supervisory process to reorient our focus more towards material financial risks and to improve other aspects of our supervisory framework. Among other things, we have issued a proposed rule along with the OCC that would define certain key terms related to supervisory criticisms, are working with federal and state regulators on reforms to the CAMELS rating system, issued a proposal to establish an independent Office of Supervisory Appeals to adjudicate appeals of material supervisory determinations, and modified our continuous examination program, including by raising the threshold from $10 billion to $30 billion in assets, among other changes detailed in my written statement. The FDIC has also been engaging in a thoughtful review of our regulations, guidance, and manuals, and we have already taken several significant steps. With respect to capital rules, we finalized a rule to modify the enhanced supplementary leverage ratio to help ensure that it serves as a backstop to risk-based capital requirements rather than as a frequently binding constraint, proposed targeted amendments to the community bank leverage ratio to expand eligibility and encourage more community banks to opt in, and are working with the Federal Reserve and OCC to modernize risk-based capital requirements, which includes implementation of the 2017 Basel Agreement. We have also finalized a rule to raise and index 37 regulatory asset thresholds, and we continue to evaluate other thresholds within our regulations to be included in one or more future proposals. We rescinded our 2024 Statement of Policy on bank mergers and continue to work on additional improvements to the merger review process and analytical framework. And we issued a proposed rule to significantly enhance the speed and clarity of the approval process for new branch openings, which we expect to finalize later this month. With respect to bank resolution, the FDIC has, among other things, modified our approach to resolution planning for insured depository institutions based on lessons learned from the 2023 bank failures, conducted dozens of outreach meetings with banks in their capacity as potential failed bank acquirers as we seek to improve the bidding process and remove potential obstacles to lower cost bids, and implemented a number of internal operational improvements. Throughout the course of the year, the FDIC has also taken a more open-minded approach with respect to banks that offer products and services related to digital assets, while maintaining our expectation that such activities are conducted in a safe and sound manner. Specifically, we rescinded the Biden-era prior notification requirement for digital asset activities, which served as a significant barrier to banks' participation in these activities, withdrew from several interagency joint statements, including one that suggested that use of public distributed ledger systems was likely inconsistent with safe and sound banking practices, publicly released hundreds of pages of supervisory correspondence to provide transparency regarding the prior administration's misguided approach to digital assets, and have begun work to implement the Genius Act. In addition, we are also considering the recommendations included in the report issued in July by the President's Working Group on Digital Asset Markets, and we are currently developing guidance to provide additional clarity with respect to the regulatory status of tokenized deposits. In closing, the FDIC will continue to work to drive economic growth and access to capital while fulfilling our critical role in promoting a safe, sound, and resilient banking system. Thank you again for the opportunity to testify today, and I look forward to your questions.
I thank each of the panelists today. We'll now turn to member questions, and I recognize myself for 5 minutes for questioning. When President Trump, in his first term, signed S-2155 into law, there was broad at that time bipartisan recognition from Congress that the federal banking supervisors needed to tailor their rules based on an institution's size, complexity, and risk profile. I want to applaud each of you in your work in your agencies